Oil giant Chevron, ticker CVX, is now sitting around a 5% dividend yield, something we haven't seen in quite a while. But is it actually a buy for dividend growth investors today? I'm Nick, this is the Dividend Growth Income channel, and in today's video I'm diving into Chevron's fundamentals, the dividend, and whether it deserves a spot in your dividend growth portfolio right now. Oil prices have been bouncing around, interest rates remain high, and there are real questions about long-term energy demand. So how is Chevron navigating the current environment? And how does it compare to peers like ExxonMobil or Energy Transfer? What is a fair price for long-term investors to be buying Chevron? These are all questions I hope to bring some clarity to in this video, so let's get to it. Chevron is one of the largest integrated oil and gas companies in the world. This means they're involved in every part of the energy value chain, from upstream exploration and production to refining, transportation, and even chemicals. Their operations span 6 continents, and while they're heavily exposed to crude oil and natural gas prices, Chevron has a relatively diverse and global portfolio that helps balance out some of that volatility. The company generates tens of billions in free cash flow during strong oil markets and has been using that to return capital to shareholders via dividends and share buybacks. Chevron also has one of the strongest balance sheets in the energy sector. It carries significantly less debt than many of its peers, which gives it flexibility when oil prices dip, and the Standard & Poor's give it a credit rating of AA-. And while it is an oil giant, Chevron is starting to invest in alternative energy, carbon capture, and renewable fuels, though these are still a small part relatively of its business compared to its traditional fossil fuel operations. Despite the cyclical nature of the energy sector, Chevron has been paying uninterrupted dividends since 1912. Over a century of consistent payouts through wars, recessions, oil shocks, everything in between. And on top of that, Chevron has now increased its dividend for 37 consecutive years, earning the place on the Dividend Aristocrats list and making it one of the most reliable sources of income in the energy space. Its 5-year average annual growth rate of 6.5% is nothing to sneeze at for an oil company. And as of today, Chevron's dividend yield sits just under 5%, well above the 5-year average of 4.21%. That elevated yield is a big reason why income-focused investors are starting to take another look at the stock. And if the yield were to revert back to its historical average, that would imply a share price between $146 and $179, suggesting that today's levels could offer a compelling entry point if you believe in the long-term health of the business. Chevron pays its dividend on a quarterly schedule with payments typically landing in March, June, September, and December. It's a pretty standard payout cadence for U.S. blue chips. Right now, they're paying $1.71 per share each quarter, which works out to an annual payout of $6.84 per share. At current prices, that gives us the 4.96% yield we talked about earlier. The next ex-dividend date is expected for around May 16th, so if you're looking to lock in the next payout, keep that date on your radar. SimplySafeDividends.com currently gives Chevron a dividend safety score of 90, rating it as very safe, highly unlikely to face a dividend cut. That said, the current payout ratios are a little bit elevated, around 65% of forward earnings, 73% of forward free cash flow, so this is something to keep an eye on, particularly if oil prices were to seriously drop. The oil market right now is uncertain and volatile. It's shaped by a mix of geopolitical tension, sluggish demand growth, and tight supply dynamics. On one hand, you have OPEC continuing production cuts in effort to support prices, while U.S. shale production remains high, helping balance global supply. Meanwhile, geopolitical risks, especially in the Middle East and Ukraine, could continue to add pressure and keep a floor under oil prices. On the demand side, things are a bit softer. Global economic growth has been slow, especially in major markets like China and Europe. There's also growing uncertainty around the energy transition, which has some investors questioning the long-term demand for fossil fuels, even though near-term demand remains strong. As a result, oil prices have been bouncing around in a range generally between $70 and $85 per barrel. So it's not low enough to panic, but not high enough to fuel explosive growth either. So this might be what you call a sideways market right now. Lots of noise, no clear trend. Now, for a company like Chevron, this environment puts a spotlight on capital discipline, cost control, and cash flow strength. All things they have historically done rather well. So let's take a moment to compare Chevron to its biggest U.S. rival, ExxonMobil, ticker XOM. Both are integrated oil and gas giants. Both have a long history of rewarding shareholders through dividends and buybacks. From a dividend perspective, Chevron currently yields just under 5%, while ExxonMobil yields about 3.7%. So the gap has narrowed a bit. Chevron still offers the stronger income stream right now. On the dividend growth side, Chevron also holds a clear edge with a 5-year CAGR of 6.5% compared to just 2.3% for Exxon. That's a pretty significant difference, especially for investors focused on long-term income growth. Both companies boast very strong balance sheets. Exxon has done a great job reducing its debt over the last few years. Like Chevron, they now operate with very low leverage and a healthy credit profile. So from a financial strength standpoint, it's pretty much a draw. Where Exxon differentiates itself is in its strategic bets with major investment in Guyana's offshore oil reserves, LNG, and carbon capture. These could deliver substantial long-term upside, but they also come with some execution risk. In terms of recent total returns, Exxon has outpaced Chevron, largely due to the aggressive growth positioning and a stronger rebound off the 2020 lows. But if you're looking for higher income and stronger dividend growth, Chevron looks more attractive at current prices. If you're focused on long-term growth potential and strategic upside, I think Exxon has its own appeal. Now, I was actually asked in a prior video if I thought an Exxon investor should just sell their position and move into Chevron. And my answer to that is no, I don't think that's necessary. Both companies have their merits. Chevron might offer the higher yield, stronger dividend growth, but Exxon brings more long-term growth upside and similar financial strength. Depending on your goals, both could make sense in a dividend-focused portfolio. There's no reason you couldn't hold both as well. Now, if we shift over to Energy Transfer, ticker ET, we're looking at actually a very different kind of energy business. Unlike Chevron, which is an integrated major involved in exploration, refining, and production, Energy Transfer is a midstream company. It focuses on transporting, storing, and processing oil and natural gas. So its earnings are more tied to volume and contracts rather than the price of oil itself. So the appeal there is the yield. Energy Transfer currently yielding around 7.5%, which is significantly higher than Chevron's 5%. But that higher yield comes with some important trade-offs. For one, dividend growth is not nearly as consistent. The company cut its distribution back in 2020. And while it's been growing again since, the history is something that many investors haven't forgotten. There's also the fact that Energy Transfer issues a K-1 tax form, which can complicate things for some investors, particularly in tax-advantaged accounts. The company tends to issue shares to fund growth, and it operates with higher leverage compared to Chevron. That's not necessarily a problem, but it does add another layer of risk if conditions tighten or if its volumes decline. So if you're looking for higher income today and are comfortable with a bit more complexity and risk, ET could be attractive. But if you value the dividend safety, the consistency, and a simpler tax profile, Chevron is the more conservative, hands-off option. Now, full disclosure, at the time of publishing, I only hold Chevron out of these companies. I do not currently hold ExxonMobil or Energy Transfer. Chevron's a growing position in my public dividend growth income portfolio. I share it here on the channel. I'm currently sitting on 11.721 shares, valued at about $1,616, making just under 4% of that portfolio. As the price has pulled back, I'm now down about 8% on the position. With the 5% yield, my confidence in Chevron's business over the near and medium term, I see this as an opportunity to continue adding. At current levels, this position is projected to generate about $80 in dividend income over the next year, and that income will be reinvested right back into the stock. I see it as a core holding for years to come. Chevron has also a prominent place in one of my favorite dividend ETFs, that's SCHD, the Schwab U.S. Dividend Equity ETF. As of this recording, Chevron makes up almost 4% of the SCHD fund. So if you're investing in SCHD, you're already getting some real exposure to Chevron's dividend strength. And speaking of SCHD, with that fund right now yielding 4% or more, I think it's time to put together a deep dive video just like this one of SCHD. So to make sure you don't miss that, make sure you're subscribed to the channel, have the notification bell turned on because YouTube has not been consistent about pushing my videos out to you guys. And just to add one more piece of context, the average analyst price target for Chevron right now is a little under $170. That represents about 24% upside from where the stock is trading today. So not only are you locking in a 5% yield, you're also getting that potential double-digit capital appreciation runway if the market begins to reevaluate the stock. Now, just to be clear, I'm personally adding to Chevron at these levels, but that doesn't mean I'm suggesting that you should. My goal with these videos is simply to provide as much clear and unbiased information as I can, so that you can make your own informed decisions based on your own personal goals and risk tolerance. Thanks for spending some time with me today. I hope this breakdown gave you a clear picture of Chevron, where it might fit into your dividend growth strategy. And until next time, my friends, keep investing.